Welcome to Bullshift, the podcast where we talk about how the financial services industry shifts your attention to make you feel more bullish. My name is John DeGuy. I'm the host of the podcast and the author of the book Bullshift. Thank you so much for joining us. Our guest this week is Jonathan Chevreau. John has been a mainstay in the Canadian financial services industry for over a generation. He's spent almost a decade as the personal finance columnist for the Financial Post. He's been the editor for Money Sense magazine, and he's written a regular book for a number of years on rating mutual funds, and two other books that are bestsellers, Victory Lap Retirement and Findependence Day. And he currently works as the manager of a place called the Findependence Hub, which helps people work out different challenges with regard to personal finance. John, welcome.
Thanks, John. I might say it's actually been 2 decades that I was almost at the post.
Oh wow, it's funny how time flies. You like I say, you really are a mainstay in the industry. So thanks so much for joining me. One of the things that we talked about before doing the taping was how you had a whole history of running the gamut of being a person who didn't start in finance, and then you started writing in finance, and you got an advisor, and then you changed advisors and did different things, and now you're a bit of an advocate for do-it-yourself investing. Could you perhaps tell us about your journey as a person who has gone sort of across the spectrum of financial advice?
Sure, John. I mean, journalistically, I actually started in high tech when I was at the
Mm-hmm.
Globe and Mail in the early '80s. So I still remember interviewing like Steve Jobs and Bill Gates and all these people. Um, then I went freelance and sort of freelance high tech. And anyway, long story short, I went back into journalism at age 40, which was the Financial Post. And I sort of switched from writing about technology to writing about money, personal finance, investing, etc. And as you said, I wrote a bunch of mutual fund guides. Back then, it was Gordon Pape, and there was a bunch of people like Duff Young and myself and Riley and other people who wrote other mutual fund guides. Nowadays, I'd probably be doing smart ETFs instead of smart funds. Um, so in the course of doing that, I decided that at one point I had a full service advisor, and he was very good. And actually, I still have him write for the Hub as you do sometimes. Um, but at one point, his company prevailed upon him to switch full service. Basically, I was only paying commissions on trades executed, and since I was a buy and hold investor, I was quite happy with full service advice, because if you buy, BCE or a bank stock and you hold it for 30 years, you're not really generating a lot of commissions there, or nor are you paying. Or subsequently, as I gradually moved from mutual funds to ETFs, same thing. I mean, happy that the advisor would get paid the trailer on the ETFs if there are any, but there wouldn't be a lot of buy and sells. Anyway, for whatever reason, this particular individual's company insisted that they move the whole thing to an asset-based model. And when I did the math on that, it was like, well, gee, this is going to cost me a fair bit of money. And at the same time, I already had a fee-for-service advisor, Fred Kirby, who doesn't take clients anymore. He's retired pretty much himself. And he was the one who taught me how remotely, because I only met him once in person, how to go to the RBC Directs or the TD Waterhouses of the world and become a do-it-yourself investor, making your own trades, ideally paying $10 or less per trade. So that was the long and the short of it. So right now, I've always had an advisor, but the circumstances have changed over the years.
Given that you've always had an advisor, and given that there's a wide swath of people in Canada who work at various stages with various expectations of what they should be getting from an advisor, could you perhaps offer your thoughts on how you would surmise the market segments itself in terms of who really works with an advisor and really needs to work with an advisor, who's a do-it-yourselfer and understands they should be a do-it-yourselfer, and maybe the people who are working with an advisor but could be doing it themselves, and people who are doing it themselves and could be working with an advisor. How well do you think the Canadian marketplace segments itself in terms of determining whether or not it needs advice?
Well, number one, a financial journalist like myself is not a typical case because I mean, even though you and I don't have a formal relationship, I'm sure if I called you up and said, John, what do you think of this or that, you'd oblige me with a pretty good answer for nothing. But and then in return, maybe I could do something for you, quote you in money cents or something like that. So I can, in a sense, I have hundreds of potential financial advisors that I access through email or phone. So I am not by any means typical, nor do I claim to be. Um, so I think, but the average person who has a real job, they're working for Bell Canada or a bank or something, and they don't really have anything to do with the financial services industry, except for they realize they need some help. Well, in that case, I think certainly a 1% fee on the based on assets is not out of line. Some would charge more and some would charge less. Keeping in mind that if the solution ultimately is a bunch of ETFs, which is not a bad way to go, then you'll be paying the underlying ETF fee, typically 20 basis points, plus whatever fee that you negotiate with the advisor. And I don't think, I mean, if it's just the investments, I mean, you could get by with nothing but go to discount broker and something like VBAL, Vanguard's balanced ETF, or XBAL or ZBAL from BMO and iShares, and you're paying 20, 22 basis points. And that's basically all you need from an investment perspective. It's going to give you like 3,000 plus stocks and bonds all around the world, all market caps, etc., with regular rebalancing. So it can be that simple at that level, but that doesn't mean you know anything about life insurance. Do I need it? Do I need annuities? How do I optimize my asset allocation across different accounts? Registered, non-registered, TFSAs, all that. Um, Financial planning in the long run, where you start thinking about spousal RSPs and how do I balance income from my spouse and maybe make provisions for my children in the untimely event of one's demise. I think it's though in those all those other cases, you could pretty well make a case for 1% being a fee that's reasonable on assets, provided that the person, and then most of them do, need all these other things apart from just the idea of like, I'm just going to invest in BBAL and be done with it.
Right. And provided, of course, that those things are actually being offered by the advisor, because some advisors just do the investing. They don't have a financial planning overlay. They just take care of that. But if you can do more, obviously, if you can amortize the price you're paying over a wider range of more comprehensive holistic services, it makes it a little bit easier to swallow, especially if the advisor is working with non-registered assets, because then part of the advisor's fee can be tax deducted as well. So can be deducted from your taxes, which makes it maybe even a little bit lower on an after-tax basis. Thinking about how different people view the quality of advice, you and I have both been mostly favorable about advisors, but we've also both been critical of advisors from time to time. Could you offer your take on maybe the best and the worst of what you see with the advice industry in Canada, and if there are certain biases that you see within the advice industry, what are they, and why do you think they might still be persisting?
Yeah, well, again, I think it all depends. Are we talking about somebody who's like a mutual fund dealer association? Do they still call it that? I guess
The whole thing. Let's go
yeah.
through the whole gamut.
Yeah, I mean, when I first started in the industry, actually, I think I believe I was with one of your employers at one point, and at that point, I didn't know any better. As I said, I'd moved from writing about technology to writing about money, and the mutual funds seemed kind of interesting to me at the time.
Mhm.
Probably the idea was introduced to me from reading David Chilton's A Wealthy Barber. And it took a while to realize that, because I actually wrote these mutual fund guides, smart funds. After about 5 years, I sort of thought to myself, gee, I wonder, is the very phrase smart funds an oxymoron?
Mhm.
And gradually I learned about indexing and ETFs, and so now and there was a lot of actually I wrote a book with another couple of people called The Wealthy Boomer: Life After Mutual Funds, which sort of described my own transition from what seemed to me a little bit high price, because as you know, and you've written about it, I'm sure, Canada's mutual fund fees, if they're hitting at 250 basis points thereabouts for a balanced portfolio, or let's say it's two nowadays, there were studies, was it from Harvard and other places, showing that these were among the most expensively actively managed mutual funds in the world, certainly compared to the States and probably Britain and other places. So unfortunately for Canadian financial planners who relied only on selling mutual funds, I think that would be a tough thing for them. The ones who are ahead of the curve, like yourself, um, at least went to things like DFA, which were are reasonable fees and well managed, or they went to to actual ETFs, where a typical ETF, as you know, would be a fee of between 0.2 and 0.5%, depending on what you're getting, compared to 2 to 2.5. So, basically 5 times cheaper if you do the math. At least if you did the math for me, John, you'd probably tell me that. So the do-it-yourself crowd, I think that, I mean, what I write about and the Wealthy Boomer, and then subsequently the Independence Hub, tends to be these do-it-yourself investors who they're quite happy to buy individual stocks, even though Larry Swedroe and other people, Charles Ellis, have written books calling it the loser's game, stock picking. I think a lot of them have come to this model of I'm going to have ETF, core and explore. So I'm going to have my ETFs as my core, but I may sort of super pick a few quality, obviously household name dividend paying stocks, like the Magnificent Seven tech stocks,
Mhm.
or Canadian bank stocks and BC. You almost think you don't really need to anybody to tell you that those are going to be good buy and hold investments. So for me, it's do it yourself. Ideally, a fee only advisor or somebody who runs a newsletter who you trust and have met to kind of guide you. As I say, use the word guide as opposed to advice, where you have to be actually licensed, by IROC. You have to be a financial planner, a CFP, a CFA, all those good credentials. Which the more they have, the better from the consumer's point of view.
Sure. What about bias? Do you think advisors have a certain bias in the advice they give, or and specifically, do you think there are maybe mutual fund representatives today that wouldn't recognize the oxymoron of the phrase smart funds? Do you see that? And similarly, what about with the individual do-it-yourself investors? Do you think they have biases? Are they perhaps overconfident, or are they susceptible to recency and availability and the things that might make it simple but not necessarily correct?
Well, I'd say you've written the book Bullshift. So, as I understood it, it took me a week or two to understand the phrase, but as I understand it, it's having an optimistic bias on on exhibited by the financial professionals. Um, they tend to be, as you know, pro stocks and Jeremy Siegel's stocks for the long run. That seems to be the Bible of this camp. And maybe it's true that in the long run, stocks do outperform bonds and cash. On the other hand, everything I've seen, and why I mentioned VBAL or XBAL, is I think most people need roughly a 60-40 stock bond split. And but I think going back to bias, if the advisor in the old days at least it seemed like they were paid a little better if they convinced or persuaded their consumer, the customer, to be mostly in stocks and equities. So I guess there would be a bias against GICs because they don't pay much, if anything, to the advisor. Even though right now you can get 5% on a GIC. So arguably, if you're ever going to be in GICs, guaranteed investment certificates, now would be a time to put a portion of your fixed income exposure into such products, laddered between 1 and 5 years. Um, are financial advisors who are paid by commission, or even if they're asset based, um, are they biased in favor of stocks for the long run and stocks always go up? Do they sincerely believe it is best for the client, or is it best for the client's retirement, or is it best for their own retirement? I don't have that cynical a view of human nature, so I think 95% of financial advisors do act in behalf and the best interest of their clients. But there are always the odd case. You'll see the OSC will nail somebody every year for some abuse of the book. So
Yeah, my view is that the actual number is more than 99% in terms of intent. Advisors have good intentions, but there are certain advisors that, despite having good intentions, might have blind spots, might have biases that they're unaware of. and they might do things that are unwittingly inappropriate. But it's not because they're trying to be nefarious. It's they're doing what they think is right, and they just what they think is right is not in fact what is actually right. So it's interesting. What about expected returns? Again, I want to compare and contrast because you've got a unique window to the advice industry, but also the do-it-yourself industry. Do you think the do-it-yourself investors? Do you think ordinary investors have higher expected returns when they work on their own? Or if they work with an advisor, will the advisor cause that person's expectation for what the future might hold to involve a return that is higher or lower than what the person had before they met the advisor?
Well, yeah, I guess advisors, I can see they'd be quite frustrated with all the do-it-yourselfers on the internet talking about, ad nauseum about fees in Canada's expensive mutual funds and all that. I mean, purely on the arithmetic, I guess if you take a purely index solution, let's say Vanguard's VEQT, 100% equities, or the equivalent of BMO or iShares, you're talking maybe 20 basis points. So you could argue that you're getting the market and you're not subtracting 2% from that. So if you go conversely to a mutual fund salesperson who has you in, even if it's 100% stocks, equities, but an equity fund, things like emerging markets, even ETFs, et cetera, tend to be, or mutual funds certainly tend to be a little more expensive than the broadly based sort of US equity funds or North American equity funds. And the more they throw you at specialized, even in ETFs, if you keep on going after like semiconductor ETF and theme ETFs and now AI ETFs, etc., well, lo and behold, those things are charging 75 basis points instead of the 20 basis points that a broadly diversified low cost ETF has. So, what are the returns? I mean, presumably, when you talked about earlier, deducting the cost of some of the advice on the non-registered portfolio, well, that's a real gain. A lot of advisors, even in F-class mutual funds or what's it, capital class, what are they called? Those uh, the funds that are optimized across for capital gains and losses in a non-registered portfolio.
Corporate
Um,
class.
yeah, corporate class. That's another way that you can pretty quickly get that 1 or 2% that you paid on the pure fee level back in terms of tax efficiency. Um,
Okay, so let me see if I can ask the question this way. If you're a do-it-yourselfer and you're working with an advisor, to what extent do you change your underlying investments? Do you switch from funds to ETFs or ETFs to funds or stocks to ETFs or what have you? And then do your expectations for the returns that you're going to have. Let's say you go from a U.S. equity mutual fund to a U.S. equity ETF, and even when you hold the cost of the advice constant, the difference in price might be, say, 1%, because you got to pay the 1% advisory fee either way. Um, does that person then say, oh, I've just reduced my cost by 1%, therefore I've just increased my expected return by 1%? How many investors do you think go through that? Because the logic is pretty much irrefutable, but I don't know that I see a lot of people that actually think that way.
yeah, it's been a couple of years now. You tell me, since even the ETF statements, you aren't they're required to show what the actual cost is. So when people say, in the old days, the mutual fund industry got criticized because you get a naive customer saying, "Oh, I don't pay anything," because they don't actually see the fee coming deducted from their account. Like if you have $1 million and you're paying 1%, then that's, what is that, 10,000 a year?
10,000 a year.
And it might be 20,000 a year. So I mean 20,000 a year, that's like, more than 1,500 bucks a month. That's real money coming out of your pocket in somebody else's pocket. I think the do-it-yourself crowd can figure it out pretty quickly. But maybe they can have a core, which are really low cost fees. Maybe with let's go back to the 0.2% that they can live with. That's a fifth of the 10,000, so 2,000 a year. Yeah, that's sustainable. And then you may buy individual stocks and dividend paying stocks and the odd, theme ETF that costs more, maybe pays more, but you're doing that in the expectation that the bet on whatever it is, semiconductors or AI, is going to more than pay for the extra cost. that that ETF brings with it.
What about the notion of behavior modification? A lot of advisors will say, I'm a behavioral coach. I can help my clients do a better job of reaching their goals because I can avoid where the skeletons are buried. I can help them. Again, I want to compare and contrast because of you have this unique experience. Do you think advisors help or hurt, or maybe not neither, in terms of changing the behavior of an investor? And maybe let's say if you take it from the perspective of the opposite of what you say, you've gone from being a person who had advice who went from do-it-yourselfer. Let's say you're going from a do-it-yourselfer. You've been doing it yourself for a while. You decide that you need an advisor, so you work to an advisor to work with an advisor. To what extent do you think that advisor will be able to modify your behavior in either direction? And if it's good or bad, would you even try to weigh in on how much good or how much bad is being done? Is it a half a percent? Is it a percent annually? I wonder if you got a thought on that.
Well, I think in this case, you're basically having an ex do-it-yourself investor who's decided to fire themselves for
Yeah.
their ongoing incompetence. And usually, I mean, any do-it-yourselfer has definitely lost money. I can give you even now examples where I like bought Lordstown Motors, which was basically went bankrupt and lost every penny. Another bad example, I'm ratting on myself, is buying a Russia ETF because I thought it would be a good oil play about a month before the Ukraine invasion. Invasion. Those are two that went down to zero. Now, fortunately, I also don't believe in having big bets. So these are small bets. It would be nice if the money were still there, but it isn't. So I mean, there are days I certainly look back and say, I should fire myself and go with John DeGoey or anybody else who could save me from myself. So the question is, okay, but then again, I'm sort of contradicting myself because I said, well, I don't need to be buying Lordstown Motors or some specialized ETF where I'm bringing on way too much political risk or single concentration risk. I already said all you need is VBAL or ZBAL or XBAL and be done with it. But it's a lot easier to say in theory that's all you need to do. Unfortunately, I think, and I mean, I think a lot of the do-it-yourself investors that are on the internet are a victim of this too. They look at this almost as a form of entertainment, not quite up there with gambling and going to Vegas. Um, and if they're doing, they're on Twitter and social media, they like to say, "Hey, I bought Nvidia," or I sold something bad just in time. So to the extent that they've fired themselves and found an advisor who can say, look, this is your money, this is your future, this is not a toy, this is not Las Vegas. If you want to gamble, why don't you go to Las Vegas? You probably save money in the long run. So yeah, I think if you're thinking of firing yourself, you probably have good reason to do so, and you should therefore be a good candidate for finding a good professional, ethical financial advisor who charges a reasonable fee. They've got to be in business, or else they can't really provide any advice. So, like anything, there are compromises.
Good. So for the past 6 or 7 years, or maybe even longer, I don't know, you've been running the Findependence Hub. And it's been out doing what it does, helping to educate the Canadian public about much of the things that you and I have been discussing in this podcast today. Can you tell people about the Findependence Hub, what it is, what your mandate is, and how it's been going?
Yeah, it's been almost 10 years now. I had left the full-time employee of Money Sense in 2014, and so and one of the things I did, there's a bit of a financial aspect to this where I was able to kind of float for a bit. And that's when I launched the Findependence Hub, or Financial Independence Hub. Obviously, the word Findependence is just short for financial independence. I'd written a book, Findependence Day, which really is just Financial Independence Day. You could say it's about retirement, for lack of a better word. And as you know, because I've often written, run blogs that you've written, either directly for the hub or more often probably for one of your employers. So what we have there is I'll write the odd piece, one or two a week maybe, and the stuff I write for Money Sense I'll put on as well. But there's a lot of executives from the mutual fund or the ETF industry. They're like, like vice presidents of marketing, or ideally investment counsels, and financial advisors like yourself. So these people have credentials that I don't have. I don't have a CFA or a CFB or anything like that, but I'm happy to run blogs by people who do, because I would hope that anybody who writes for the Hub has at least one of those two, if not both. Um, so and my because when I was at the Globe and Mail, my motto as a reporter was a story a day keeps the editor away. For the longest time, my self-imposed goal was having a blog every day, every business day. Now that I've reached age 70, I'm trying to slow down a bit, and I may every some weeks just go 4 times a week, taking the Wednesday off. But for the most part, and of course it's free, so all you need is an email. I realize a lot of people get a lot of emails these days, so it's one more email people may welcome or delete.
Yeah, and that's their prerogative. All right, we're getting toward the end here. So the thing that I do with all my guests at the end of my podcast is I have two sections where I like to ask them what their thoughts are. And the first is a section that I call "That's Bullshit." Can you think of anything in the industry that you think could be done differently, and specifically that could be done better? What exactly is sticking in your craw these days about financial services?
Well, I think we've touched on it already, and I think some of these theme ETFs I think are a little overdone. I mean, AI is the big thing right now, but ironically, you probably did better on AI by having the QQQs, the Nasdaq 100 ETF that would have hold the Magnificent Seven, as they call them, Microsoft, Nvidia, all those guys, as opposed to supposed AI play. I had some little robotics and AI theme fund I experimented with 2 or 3 years ago. Last I checked, it hasn't done it anywhere near as well as like the QQQs would have. So I think there's this danger in we I think who's it? Eric Kirshner used to talk about gambler's ruin. You know, where you have a good idea in a sector, you want to pick this particular stock, let's say Nvidia for AI, but instead of buying just the one stock, in which case you could be wrong, and you buy a basket of all the AI stocks. But then the basket, as I said with my Russia ETF example, you could buy an entire country and get wiped out. So I think you can't. I think there's a bit too much of an emphasis on these theme of the day ETFs. They tend to be like 3 times more expensive than the broadly based diversified ones. Um, so I think that is an example of bullshit. If you get the ideas not from the internet, but from some advisor who, for whatever reason, thinks it'd be really good to have all these theme ETFs, you might just as well just stick with a low cost ETF.
Right. Okay, well, that brings me then to the second half, which is shift happens. So you've just identified a problem, which is the concentration into thematic ETFs and thematic investment products. Shift happens is, if it were up to you, if John Chevreau could have a wave a magic wand and fix the problem that he's just identified, how would you fix it? What would you do to actually deal with the problem of concentration in the ascendancy of thematic products?
Well, I think thematic product to me is it's just another version of single stock risk where you buy, put all your money on a. I mean, we could go into IPOs and SPACs and cryptocurrency, but that may be some other show we can do that. But as to the solution to the problem we're talking about, I think you're safe as long as you don't have more. I mean, a lot of people would say, well, you only need 20 or 30 stocks if you're a stock picker, and no more than 5% in any one of them. I would take that and make it like 1%. I did personally invest a bit in crypto and more or less broke even because I was early, but also not a little late getting out. But for me, 5% would be too high in any one speculative or theme ETF or crypto, etc. Like 1%, I think is reasonable. And then it's the old, if you get a double, sell half, and these kind of basic risk protection measures, which if you're not familiar with them, you probably do need an advisor, because I'm sure you would be able to tell people exactly how to deal with this situation.
Perfect. Thanks so much, John. It's been a real pleasure. I always enjoy my conversations with you. We should probably do it again sometime in the not too distant future. I want to wish you all the success in the world with what you're doing with Independence Hub. You've been a real inspiration for the industry, because you've sort of navigated from being outside of the industry to being a journalist for a paper, to being an editor for a magazine, and now going off on your own and doing all these other things along the way. Fascinating story. It's been a real pleasure speaking with you today.
My pleasure. Thanks for including me, John.
John DeGooey is a portfolio manager in Toronto and the author of the book Bullshift, How Optimism by Bullshift is available online and in bookstores everywhere. The opinions expressed in this podcast should not be construed as investment advice. Bullshift, the podcast, is produced by TalkShoe, a division of IOTM.